Today we're going to be doing the next episode of the EA Bootcamp, and today we're going to be going over risk. Risk in general, how to actually approach risk on an eval account, on a funded account, and even if you want to approach it with live capital as well. I'm going to be going over exactly how I approach my risk parameters when I trade, specifically for these funded accounts, but you can also apply it to live accounts as well. Let's get straight into it. The most common risk, or risk to reward, which all that means is if you're risking A amount, your reward is B amount. So this is what a risk to reward looks like on your chart. This is for longs. Like, let's say you're in a long position. You're aiming for the market to move up. These are longs. So the most common types of risk to rewards is a 1-to-1, a 1-to-2, and a 1-to-3. Now, what does this mean? Let's say you're risking $500 per trade. On a 1-to-1, if you risk 500, you're aiming to make 500. In a 1-to-2, if you risk 500, you're aiming to make 1,000. Now, and you can already imagine on the 1-to-3, if you risk 500, you're aiming to make 1,500. Now, everything looks great. Now, it doesn't mean that you have the highest win rate on the 1-to-3. There's also a win rate that applies to these metrics. Risk to reward just means like how much you're making on an individual trade. If you're risking 500, your reward is the metric applied here. 1-to-1, 1-to-2, 1-to-3, there's obviously higher metrics, but these are the most common. I personally aim for a 1-to-2. Sometimes less, sometimes a little more. It depends on the trade and how it is moving. But the most important thing about this when using risk is how you associate it with your account. So most prop firm accounts, most people that trade prop firms start with a $50,000 account size. And the $50,000 account size comes with a $2,000 drawdown. That's how it starts, most accounts. Now, this is based off my metrics and my data. If you have your own strategy, a strategy that you already trade, make sure to go on FX Replay, back test it, get data on it, see your win rate, and see your risk to reward. Right? Now, for me, and it also tells you your max consecutive losses. For me, I normally do not have a consecutive loss more than 3. What this means is I normally don't have 3 or more consecutive losses. Like 3 would be the max I normally take. There's obviously a chance that an anomaly happens because it is trading. Anything can ever happen. There could be a chance that I take 4 consecutive losses and I blow the account. But on a normal day, on a normal week, on a normal note, I shouldn't take more than 3 consecutive losses. Now, what does this tell me? Okay, so if I'm not normally going to take 4 consecutive losses, that means I can risk a quarter of my drawdown per trade, because if I'm not going to take 4 consecutive losses, that 4th trade should put me back up in my balance, right? And this is exactly what this says here. The percentage of drawdown you should risk is a quarter of your drawdown. Now, if you have more consecutive losses, then you're going to risk less of your drawdown. So the more consecutive losses that you are seen to have, you want to decrease the percentage of your drawdown. I personally risk a quarter or 25% of my drawdown, meaning I aim to risk around $500. And this is only if you're trading very few accounts, like 1, 2, maybe even 3 accounts. I personally am trading 8 accounts right now, so I diversified, or I guess you could say I spread out my risk and I decreased. I only risk around $400 per trade per account, and I aim for 1-to-2, sometimes a little less than 1-to-2, but that is my metrics. So if you guys are looking at, oh, how much should I risk per trade? You should be risking a quarter of your drawdown. But what I'm going to tell you guys is that if you guys are on an eval, you should be risking aggressively. Evals are meant to be blown. Evals are you either pass the eval or you blow the eval. You should not be on an eval for more than a month, more than 2 weeks. Realistically, you should be passing an eval within 2 weeks. You should be risking aggressively. I personally like to risk at least 1 mini per trade on evals. If it's a good trade setup, aim to risk for 2 minis. But the idea is to pass these evals pretty fast. Be efficient with the evals so you have time on your PAs. Think about it like this. You have 2 weeks of price action, great price action, but you're on an eval. Then you pass the eval and now you're on the PA account or the real account. And the next 2 weeks are ask price action. And you blow the funded account. Guess what? If you would have passed the eval earlier, you would have been able to build some buffer on this PA or this real account, allowing you to continue trading on the real account. The idea of the eval is to pass it fast and make sure that you have adequate time to trade the real funded account. You want to take advantage of the time you have. Don't waste time on evals. I know it looks good to trade properly on the evaluation account, but realistically, this is an ROI game. It's a return on investment game. You're putting in money into an eval account. You want to see the return on your investment. So you're not going to sit through an account for a whole entire month. If that's what it's taking you to pass an eval, you should go back to paper trading, practice your strategy, gain some confidence. Because we're not here to spend hours and, well, not hours, but we're not here to spend months trading a singular evaluation account. If you can't pass an evaluation in 2 weeks, go back to paper to gain confidence, which allows you to increase your risk for these evaluation accounts. All right, let's talk about stop losses. This is just a random place on the chart. Let's say this was your trade. For some reason, you entered shorts here, and your target never got hit. There's two types of traders that trade. You have a stop loss. This is Trader A. Trader A has a stop loss. They don't actually put an order. Like, they don't have an order on the chart. They just have a mental stop loss. They're like, okay, if price comes to this level, I'll see if I want to close the trade and see what happens. Guess what happens? Trader stays in the trade and doesn't actually close the trade there, and they continue waiting. Sure, they got some hope once it starts going back down, but once it comes back up again, now they just tanked another 20 points of loss. That's Trader A. Doesn't use an actual stop loss. Once he's so deep in drawdown, he realizes, oh shit, what did I do? What do I do? I need to close a trade. They probably close a trade up here. Like I said, adding another 20 plus points of loss to their trade. Now there's Trader B, who has a stop loss of only 19 points. He gets stopped out here, and he's done for the day. And let's say they were both risking $500, right? Trader A and Trader B both were risking $500 with their supposed stop loss. Trader A, which is the guy who put the stop loss and never actually took it, ends up losing over $1,000 because the stop loss was never actually taken. He actually closed his trade up here because he was hopeful and was just waiting and didn't follow his rules. Trader B actually used a stop loss and only lost $500. Now guess what happens? The next day, Trader A hops on the chart to trade, and he's freaking out because yesterday he lost more than he should have. He lost $1,000. Whereas Trader B is okay with trading today because he knew that when he took this trade, the possibility of loss was 500. He took his loss, went about his day, and the next day he can continue to trade with the proper mentality. Now, Trader A has a mentality of needing to make back the extra $500 that he lost that was unnecessary on the trade that he lost on. Okay? So, stop losses should be set in stone. When you have a stop loss, and make sure I'm not on any account. When you have a stop loss, you want to make sure. Oh, shoot, what is this? When you have a stop loss, you want to make sure the order is there. The order should be there. You don't want the stop loss to just be there in your head and you have a stop loss nowhere and you manually close a trade. That's going to mess you up so much. You always want to have your stop loss because this allows you to define your risk adequately. Okay? And the other thing I want to show you guys is right here on TradingView. You guys see this right here? You can toggle this and this. When you're entering a trade, you can press right here where it says ticks, price, US dollars. Let's say your risk has to be 500. Now, you just click this, and you place it on the chart, and you decide how many units you want to use, and where this $500 risk would be on your chart. This allows you to see that you're actually risking the amount you said you were going to risk. Not more, not less, but just exactly the amount that you wanted to risk. Now, I want to go over one last thing. When to actually go break even, if you do go break even. So this was my entry point for the trade, right? I entered here, and we have some highs that we made here. When you guys see displacement, in other words, a fair value gap formed through a high, like this is a high, and we had a fair value gap formed through here, this shows a lot of strength in the market, which means after we close above this candle, like this one, or even this one, we can move our stop loss to break even because this fair value gap is protecting us. It's a protected fair value gap. We move our stop loss to break even after we close above this level. Then we continue going higher. We have a fair value gap created. We tap it. We respect it. As soon as we close above that fair value gap, you control your stop loss higher. And depending on how volume is, you can decide to trail your stop loss even higher. Again, depending on volume. But that is when you know to move your stop loss to break even. When you have an important high near your level and you have displacement through it, you respect the displacement and engulf that area. That is the accurate point of moving to break even. Talk about trailing stop loss, guys. This is my trade from Friday that I personally took. Now I want to show you guys what a trailing stop loss is. This just allows you to secure profits and minimize your risk, right? So the first type of thing that you want to do with a trailing stop loss is move your stop loss, okay? Let's say that you are above a level that you think we just should continue higher. You can move your stop loss to break even, meaning that this trade is now risk-free. You don't lose anything in this trade, okay? As we move through profits, you want to move your stop loss higher as we go through certain levels. Like here, we can trail our stop loss. We continue through this level, right? This level is kind of having a hard time pushing through, so you could trail your stop loss to here. What this does is it allows you to secure profits no matter what happens. If it comes down and it takes you out, you secured 645. Okay? Let's see what happens here. This is the trade that I took on Friday. Okay, it took me out for my trailing, and then guess what happened? The market decided to continue dumping. Now, if I would have been greedy and continued to just hold my trade for my TP to actually get hit, guess what would have happened? I would have ended up losing this trade and eventually losing the trade, but getting caught in this entire chop, as you see right here. Right? The most important thing in the market is to secure profit. When the market makes money available to you, make sure that you are securing these profits. $600, guys. I mean, where do you make $600 in how long was that?
$600 in 35 minutes. Where do you see that?
Where do you see that besides trading? Make sure to lock in your profits and not be greedy. I know it's easy to fall into the face of social media. When you see a big trader making $10,000 in one trade, it's okay. It's okay to see that. You're not at that level right now. You have to build your own foundation and take profits when it becomes available. For example, for me, I took that trade. I like to secure profits. I have 8 accounts. $600 across 8 accounts is a fuck ton of money. Like for me at least, I mean, not for some people, for me, it's a good amount of money. But secure profits when the market makes it available to you, and you will never regret it. I never regret it. Even if it continues going higher, I'm like, oh, well, I could have held it. But in the long run, stacking wins is more important. Protecting your capital is more important. All for today's video based off risk, how to manage risk properly in a trade, and how much you should be risking in general with your accounts, okay? Remember, it's a quarter of your account or 25% of your account if you have a 60% win rate or higher. If you have less than a 60% win rate, I would risk less, around 1/5 or 1/6 even of your account size is drawdown. Your account size drawdown, sorry. But yeah, that's it for the rest of the video, guys. Comment below what you guys want to see next on the bootcamp videos, and make sure to join the Discord. It is 100% free. The link is down below, and I live trade every single day at 9:30 a.m. Eastern. See you, boys. Peace.